Derivatives are financial instruments that get their value from an underlying asset. Think of it like a side bet on something else. Instead of buying a stock directly, you could buy a derivative that goes up in value if that stock performs well. These assets can range from stocks and bonds to commodities like gold or oil. Derivatives are not traded directly like stocks. Instead, they are contracts between two parties. Imagine wanting to buy a house next year but worrying about rising prices. A derivative could help you lock in today's price, protecting you from future increases. Derivatives are complex instruments, but understanding the basics can be surprisingly straightforward. Derivatives work by creating an agreement between two parties based on the future price of an underlying asset. Let's say you think the price of corn will go up in a few months. You could enter a derivative contract to buy corn at a specific price in the future. If the price of corn does go up, you would profit because you locked in a lower price. On the other hand, if the price of corn goes down, you would lose money because you would be obligated to buy it at the higher price you agreed upon. This example illustrates how derivatives can be used for both speculation and hedging. Speculation involves using derivatives to profit from price movements, while hedging aims to reduce risk. Derivatives are widely used by individuals and institutions to manage their financial exposure and potentially enhance their returns. There are several types of derivatives, each with its own characteristics and applications. 4 common types are futures, options, swaps, and forwards. Futures contracts obligate the buyer and seller to trade an asset at a predetermined price on a specific date. These contracts are standardized and traded on exchanges. Options contracts give the buyer the right, but not the obligation, to buy or sell an asset at a specific price on or before a certain date. Unlike futures, options provide more flexibility. Swaps involve exchanging one stream of cash flows for another. For example, a company with a fixed-rate loan might enter an interest rate swap to convert it to a variable-rate loan. Forwards are similar to futures but are not standardized and are traded over the counter. They are private agreements between two parties. Each type of derivative serves different purposes and carries different levels of risk. Understanding these differences is crucial for making informed investment decisions. Section 4. Real-world applications of derivatives. Derivatives play a significant role in various financial markets and are used by a wide range of participants. For instance, airlines often use fuel derivatives to hedge against rising fuel costs. If the price of jet fuel increases, the derivative contract would offset some of the losses incurred due to higher fuel expenses. Farmers use derivatives to manage price risk associated with their crops. By entering a futures contract, a farmer can lock in a price for their harvest in advance, protecting them from potential price drops. Investors use derivatives for speculation, portfolio hedging, and arbitrage opportunities. Hedge funds and institutional investors utilize derivatives extensively to manage risk and enhance returns in their portfolios. Derivatives are versatile instruments with applications across various sectors and investment strategies. Section 5. Benefits and risks of derivatives. Derivatives offer several potential benefits but also come with inherent risks. One significant advantage is their ability to hedge against risk. Businesses can use derivatives to mitigate uncertainties related to interest rates, commodity prices, or currency fluctuations. Investors can use derivatives to manage portfolio risk and potentially enhance returns. However, derivatives can be highly complex and involve leverage, which can amplify both profits and losses. Inadequate understanding of derivatives can lead to significant financial losses. The use of derivatives for speculation can also contribute to market volatility. It's important to approach derivatives with caution, conduct thorough research, and seek professional advice when necessary. Understanding the benefits and risks associated with derivatives is essential for making informed financial decisions.